Welcome to DWS Market Outlook. Market watchers will probably have noticed that bond yields have started to rise again after moving sideways for quite a while. The rise in yields on short-dated bonds was particularly pronounced. Two-year German government bond yields rose from 2.5% in early May to 3.25% recently. For two-year US government bonds, the increase over the same period was even more pronounced, amounting to more than 1 percentage point. The rise in yields reflects the market's expectations that first, higher policy rates will be needed, and second, that central banks are likely to keep interest rates higher for longer. In the case of long maturities, the rise in yields was somewhat less pronounced. It is worth noting, however, that since the second quarter, yield moves in both directions have been driven almost exclusively by fluctuating real yields, while inflation expectations have hardly moved at all. Translated into plain English, the market's message to central banks can be described as central banks are credible in their fight against inflation, that they will succeed in bringing inflation rates down, but that markets are wondering how high policy rates will have to be raised and for how long interest rates will have to stay at high levels. So far, the stock market has not really taken note of the rise in bond yields. In the case of some market segments, which had reacted particularly sensitive to rising yields last year, one could even observe some kind of a decoupling from the bond market. High expectations for artificial intelligence might well have played a role here. It remains to be seen whether the stock market will remain immune to rising yields. It is all the more important that the central banks remain credible in their policy to get inflation back under control. That's it for today. Thanks for watching and goodbye.